Hey everyone, Mr. Taylor here with your e-learning lesson for today. Today we're going to be talking about credit and more specifically the cost of credit, what it costs to borrow money, how we go about calculating that cost, and why it's important to understand how to figure up that cost when you are indeed borrowing money. So today we're going to define interest, talk about the factors that determine loan interest rates or an APR, and we'll talk about what an APR is. We're going to compare the advantages and disadvantages of both fixed and floating loans as well. And then finally, we're going to explain how to calculate both simple and compound interest. So first of all, what is interest and what factors determine loan interest rates? Interest is simply the cost of borrowing money. Most institutions that loan you money, whether it's a bank or a credit union or the federal government, whatever, when they agree to loan you that money, they don't do it for free. They go into it with the intention of making money. Lending is a big business in the United States. There are many companies that are built around loaning money to both individuals and companies. And interest is the money that they charge you to loan you that money. It is a cost involved when an item is purchased on credit or with borrowed money, or it can be income when someone else uses your invested money. So you can pay interest, but you can also earn interest, and we'll talk about that a little bit later. So, over the course of time, up until the last 50 years or so, loans were just simply money. Someone would go to a bank and they would say, "I need $10,000 to purchase, land or something like that." The bank would either agree to that loan or would deny that loan. If they agreed to it, they would give them the $10,000, and then the person that borrowed the money would be responsible for paying back the $10,000 plus the interest at whatever rate they agreed to that interest at. More recently, other forms of credit have came into to play. Things like credit cards are a form of credit. You're not The bank isn't giving you a check, quote unquote, to for those funds, but they are giving you a card that does have a line of credit on it, usually limited to a certain amount, and whatever you put on that credit card, you have to pay off plus interest. So the interest rate is the percentage rate that is charged for borrowing money. Now, this number is going to vary quite a bit. The most common type of interest rate is an annual percentage rate, or APR. An APR is the percentage of the loan borrowed that will be charged on the loan per year. APR, annual percentage rate, annual meaning every year, and then the percentage rate for the entire year. And there's several things that are going to influence the APR that an individual is able to qualify for. So lending institutions will oftentimes charge interest rates based on the amount of the loan and the length of repayment. So if a loan is going to be repaid in a shorter amount of time, they are a lower risk for the lender. There's less chance of default, so typically the lender will give you a lower APR rate, whereas a loan that is stretched out over a longer period of time, the payment terms are longer, odds are you're probably going to get a higher APR because the lending institution views that as a higher risk. The longer it takes them to get their money back, the higher risk they view of not getting that money recouped from you. So typically, longer term loans will have a higher APR. Another thing that can adjust APR is the federal government, especially when it comes to housing. So the federal government will adjust interest rates, and that can affect the typical borrower. So as economic conditions worsen, unemployment tends to rise. That can all, you know, lead to a decrease in overall spending, sometimes a recession, sometimes a depression. In that situation, a lot of times, one of the solutions that the government will offer to help try to get our economy stimulated again is they will actually lower interest rates. And that allows banks to, in turn, lower their interest rates. Basically, the federal government controls the rates uh, of the Federal Reserve, and once they adjust those interest rates, that allows banks to lower their interest rates. And the idea is If you lower interest rates, that gives people more incentive to borrow money to buy homes, to start businesses, and in doing that, it kind of helps to re-stimulate the economy. So don't be surprised if, in the next few months, as we continue to kind of see the fallout of this pandemic and the impact it's had on our economy with businesses being shut down and economic activity being lowered, don't be surprised to see the federal government lower interest rates as a response to that to try to jumpstart the economy a little bit. So there's two types of interest rates on loans, and that is a fixed loan and a floating loan. So a fixed loan, okay, is a loan where the interest rates are negotiated at the start of the loan and they do not change over the loan's lifetime. So you agree to a specific interest rate once you borrow the money at the very beginning of the lending term, and that you're locked into that particular interest rate for the entire time. You don't have to worry about that loan going up and down. So it's kind of like when we talked about futures markets when it came to commodity pricing. Some of those contracts that we discussed, their advantage was that they locked you in at a specific price, so you weren't at risk if the price went down, but at the same time, you were limited if the price went up. So uh, a fixed loan is kind of like that. If you're okay with being locked into an interest rate the entire time, that's fine, but you have to understand that, let's say, for example, it looks like this example over here, they're giving say for a 30-year fixed rate mortgage, they're giving you 6.37%, and you lock into that. Well, if the next year interest rates go to 4.5 or 5%, that's just too bad. You're still locked in 6.37. But you can rest easy knowing that your interest rate is never going to go up from what it is right here. That allows you to budget and to plan. And the beauty of a fixed rate mortgage is that it does allow you to budget. Most Americans, I would say 99% of Americans, have to budget when it comes to paying their mortgage, making their car payment, paying their electric bill. They're on a certain amount of income and they have to know and be able to predict what their costs are going to be on a month to month basis. And most Americans don't want their mortgage to fluctuate from one month to the next. They want to know that my mortgage payment is $1,100 this month. It's going to be $1,100 next month, the month after that, the month after that. And that's the beauty of a fixed mortgage rate. The second type of interest or loan is a floating loan, otherwise known as an adjustable rate loan. And they have an interest rate that can change over the loan's lifetime. So because this rate can increase as well as decrease and is fairly unpredictable, it may be an option for borrowers who do not have the credit score to obtain better lending terms. So a fixed loan, banks realize that uh, most borrowers want a fixed rate loan. So they only offer fixed rate loans to those that meet certain credit criteria. If you have poor credit or maybe no credit at all, a floating loan might be the only option that you have. And that's just because you're a higher risk in their view. So a floating loan makes your extra risk uh, more appealing to the bank. So floating loans have their place. They can be useful for obtaining loans over a short period of time, but you have to be careful over the long term. So a floating loan is okay if you're, let's say you're borrowing money to purchase or to make some improvements to your home, and you borrow, $5,000, and you plan to have that paid back in less than 5 years. Well, okay, that's pretty doable and pretty low risk. But where it gets dicey is when you start to use floating loans for long-term mortgages. So you take out a floating loan on a 30-year mortgage, that's a lot of risk and that's a lot of unpredictability. And you guys were pretty young when it happened, but in 2008, 2009, the American housing market crashed. And one of the big reasons why was because of these adjustable rate loans. Banks and lending institutions were loaning money to people that did not have the credit, that did not have the capability of paying those loans back, but they were able to give them those loans because they were floating rate loans or adjustable rate loans. And people were, signing on the dotted line, quote unquote, for these mortgages because when it started off, you know, they were getting an interest rate of 5, 6%. and they could make their monthly payments. And then what began to happen is people got mortgages that they couldn't afford. So they began to default on those mortgages. And as more and more people began to default, the interest rate started to go up. And these adjustable rate loans that didn't have a fixed interest rate, they began to crank up the interest rate on those. So all of a sudden, their interest rate might have gone from 6% to 10%, which is a huge, huge bump. And people were seeing their mortgage payments that were due almost double from one month to the next. Well, the average American, with a fixed income, isn't going to be able to see that wild fluctuation in their mortgage payments. So more and more people began to repay or began to default on their loans. And just like that, the American housing market really, really took a turn for the worst. So let's talk about how to calculate interest. We'll talk about two types of interest. We'll probably only get to one today, and then we'll get to the other one on Friday. But there's two major types of interest. There's simple interest and compound interest. Simple interest is also known as the add-in interest method, and it's calculated by using the original principal for the entire time period in years at the determined price. So the principal is the amount of money borrowed, and then you calculate total amount paid back by taking the principal, the amount that you borrowed, and adding interest to it. So the formula for calculating simple interest is interest equals principal times rate times time. So the principal is the total amount borrowed. Let's say you borrowed $10,000. That's your principal. Your rate is the interest rate. So let's say that you borrow it at 5% interest. So principal would be 10,000, rate would be, if you convert it to decimal form, 0.05. And then time is the number of years the money is borrowed. Maybe you borrow that money for, say, 3 years. So lending institutions typically convert this into months. So 3 years is 36 months. If you take 12 times 3, 36 months is what that comes out to be. So here's a quick example for you. Determining the interest amount on $3,000 at 8% interest for 1 year. Real simple equation. So the equation, interest equals principal times rate times time. So our principal is $3,000. Our rate is 8%, in decimal form 0.08, okay, for 1 year. So just one for that. The 8% is converted to decimal form, as we said. So if you run those numbers, 3,000 times 0.08 times 1, you get $240. And then you add that $240, $240 to the 3,000, and over the course of that 1 year, okay, you have paid $240 to borrow that $3,000, bringing your total amount paid to $3,240. So that is simple interest for you. Okay, we'll stop right there. You have questions to answer on Canvas. Tomorrow we will talk about, we'll do another example or two on simple interest, and then we'll talk about compound interest and how to calculate that. Have a great day. Let me know if you have any questions. Thanks.